Hello, Justin.
How you doing, sir? Great to see you.
Good to see you too.
Excellent.
So shall we build some portfolio?
Let's jump in and let's show folks how to build a portfolio in RiskSmith and try a few different things out. See if we could build a good one today, huh?
Let's do it. At a minimum, I think we'll show people how incredible the user experience is that we've started to build. I'm not saying we finished it, but really excited about what we're building here. And I can't wait to show it to people and talk about, what's to come.
Yep, absolutely. Let's dive in. So where do you want to start today?
I just have been playing around a little bit. Well, look, let's start from the beginning here. Let's just log out and show people risksmith.com, app.risksmith.com. Let's start from the beginning. Log in. Boom. So right now, these are different portfolios that I've built over time. And here's one that I just started putting together today. And there's a few things in here that were foundational for me. These are, some of these are up for negotiation still, but actually let me get rid of all the ones that are still speculative, whether they'd be in here or not. But I got Berkshire Hathaway, I got Bitcoin, I got DBA, which is an agricultural fund. So I'm pretty convinced that inflation is here to stay. Interest rates are going up. I favor commodities right now. So this is a position that I've held for a while, DBA, and I'm still holding it. Also, gold is in here. And then a couple of ones that I've thrown in so far. One is Ford Motor Company.
I've got that one in my real portfolio.
And then this one that I've followed for a while, Floor and Decor Holdings, which I think is part of, what I would call the nesting trend that everybody's going through post-COVID. So these were just off the top of my head. I mean, not off the top of my head, but things that I just grabbed that I thought these are things that I know I'd want in my portfolio.
Yep.
All right. So meanwhile, there's 6 assets in here. It's a pretty good risk efficiency already at 1.35. That's not bad in today's market. It'd actually be good to look at like what is the S&P 500. I'm just pulling that up here. And if I click on it, I can get details. So right now, the risk efficiency on the S&P 500 is about 0.98 or a little below 1. And just briefly, what are these metrics? So risk efficiency is a measure of how well you're earning reward relative to the risks that you are taking. So it's based on something called the Sortino ratio or an adjusted Sortino. We don't need all that fancy jargon. We just want you to know this is about how efficiently you're using risk to earn reward. The higher the number, the better, right? Ideally, at least above 1. But right now, the S&P isn't even doing that, right? It's got a little more risk than it's been earning reward. So risk is in the denominator, reward in the numerator, and you ideally want that above 1. A D score, 1.77%. That means that probably once a month, you should expect this portfolio to correct at least 1.77% in a day, right? So again, this is the S&P 500. So if you have $10,000 in this portfolio, that's a correction in a day of $177. If you have $100,000, that's $1,770, right?
Yep.
So lower D score, higher risk efficiency is kind of what you're looking for as we work through this, okay? So over here in this portfolio that I just put together, I got risk efficiency of 1.35. and a D score of 1.25. So my risk efficiency is higher than the S&P 500 and my D score is lower. Sweet. Yep. And
Great
of course, we've got our killer histograms here. And you want more green than red, right? And I think this is weighted to the green so far.
Yep.
All right, so with that as a starting point, let's find some more ideas. Well, one more thing let's look at real quick, the covariance matrix here. So what is this telling us? This is telling us how much things move up and down together or not together, right? So green means moves, bright green, which you see down the diagonal here, right? This is this is Bitcoin versus Bitcoin, right? Moves perfectly together. It's a 1, bright green. Bitcoin versus gold down here, surprisingly uncorrelated, because people think of Bitcoin as the digital gold. Hasn't actually behaved that way so far, but 0.018, so very low correlation, and it's black, right?
Yep.
So gold is pretty uncorrelated here, right? The grains are a little more uncorrelated.
Yep.
But this is a great tool to be able to look at and get an idea of what's moving together and what's complementing each other.
Yep. And the reason that's important, explain to some people that may not really understand, why does it matter if things run together or not?
Because as you're moving, you want things that are ultimately going up, right? But if some of them are going up while some of them are going down, that actually has a calming effect on your portfolio, right? Yep. So ultimately, what really I think eats us up, right, is the volatility. And when we see huge moves in our portfolio, especially going against us, it's hard to stomach. Yeah. So if you can smooth out that ride and you can have, a more steady climb with less downside volatility, that's what having uncorrelated investments can do for you. Okay.
Love it.
This world that we're living in today, it's so focused, hyper-focused on this idea of like investing as a series of independent bets. It's like investing is just like, let's roll the dice and see what happens on this bet, or roll the dice and see what happens on that bet. Yep. And really, that's not the way investing works. Investing is a collection of investments, a portfolio of investments across all kinds of asset classes today, right? But that work together as a team, right? Yep. You can't have a team just of quarterbacks, You have to have complementary roles and complementary players on your portfolio team.
Yep.
So that's really what this is about.
Yep. And when you look at this covariance matrix, darker is better, more or less.
Yeah. And all right, so let's just jump off the S&P here. So my one of my favorite sources is Whale Wisdom, whalewisdom.com. I'm giving you a little peek behind the scenes here that you would see if you were a paid subscriber to Whale Wisdom, which I highly recommend. I think it's like $50 a month, or for the pro level. They've got lesser levels too. But this is showing you what the actual, professional asset managers are investing in. And they have this list called the Whale Index 100. That is the highest conviction stocks held by leading hedge fund managers. Okay.
Yep.
So one of the things I've said for a long time, I know I'm not going to spend my time pouring, financial statements, etc. I need to make sure that I'm outsourcing some due diligence on investments that I might potentially be interested in. So to me, this is a simple way to kind of narrow my universe down to 100 ideas that I know, professional money managers have done due diligence on and put their money behind. Okay?
Yep.
And then I'm looking at this list and I'm interested not really so much in large cap $10 billion. This one as a illustrative example. Let's come over here.
That's AFRM. Is that the symbol?
AFRM, Affirm Holdings, right? I think.
Ooh, look at the histogram as soon as we put it in.
Yeah. So
let's talk about that.
A wildly volatile stock, right? It's got a D score of almost 11%.
By the way,
10.6%.
That's higher than Dogecoin. Dogecoin's D score is like 9.5%.
Okay.
Was so, like days ago.
Crazy, right? So what does that mean? That means, you know, at least once a month, you should expect to lose 10% of the value of this stock in a day, right? And you can see over here, this big red bar here at the end, minus 5%, that's or greater, right? That's the largest single bar in the histogram. And what it's telling you is that, you know, more often than not, a firm is down by 5% or more in a day. Okay, can be, you know, up to 10 or 11% in a day, and that's happened. You know, this is over the past year, right? So I don't know. Be good, Justin, to actually be able to hover over this and see a number. Just
yeah, that's on the way actually. But, yeah, the total count of that. Yes, that's actually in the list.
But look, this is a volatile, wild stock. Obviously, it's been hammered during the correction, you know, from, what is this, late October down to today, down like 44%, right? I'm not ruling it out. It's got a lot of conviction from some serious asset managers. And, you know, yeah, it's down right now, but maybe it's time to start nibbling on this stock. I don't know. Let's see how it works with this portfolio. Let's drag it in.
We're at a 1.35 risk efficiency with 1.25 D score before we put it in. Let's see what happens. That's going to recalculate here. Give us our new stats. Ooh.
Took a pretty big hit.
Took a pretty big hit.
To the risk efficiency. Now, we are weighting this by volatility. So what does that mean? You can see, you know, 3.4% of the position is in Affirm, 22.45% is in Berkshire Hathaway. It's a less volatile stock, more of our capital in Berkshire Hathaway. On the other hand, Affirm, most volatile stock in the portfolio, even more volatile than Bitcoin, right? Bitcoin has 5% of this portfolio, Affirm has 3.4%. So I'm not really feeling too good about Affirm in this portfolio. How about you?
Yeah, I think if it were me, I'd pull it back out. All right. For my taste and my risk.
So we pulled it back out, we're back up to where we were before.
Yep.
So continuing on through this list, anything, you know, one that striked my interest is Atlassian.
Yeah, you know, I held Atlassian a little bit through last fall. So it'd be interesting to see what it does now. I actually ended up pulling it out of my personal portfolio based on the stats that RiskSmith was giving me last October, November. It just got really volatile and got really risky for me. And it started pulling my risk efficiency down. And when I took it out, everything started to go back up. So let's see what happens. You can see there, still pretty volatile, 5.21 risk efficiency, or I mean D score, sorry, and a 0.53 risk efficiency.
But
let's
see what
happens.
Really, it's still above its 2021 lows.
Yep.
I think it's held up better than most.
Yep.
Let's see how it works in this portfolio.
Great. Oh, and look at that.
Not bad.
It actually improved the stats. And this is such a great lesson, right? Because something that on its surface kind of looks like, I don't know. Once you put it in the portfolio bets, the whole thing changes. That's why you have to look at it as a portfolio.
I'm liking it. 1.40, our risk efficiency went up and our D score went down. Right?
Great. Yeah.
And we still got a pretty tight histogram here.
Yep. Not a bad ad. A surprising one. I like it.
Surprising one, right?
Great.
All right. Autodesk.
Autodesk, okay.
Kind
of a big cap.
49 billion.
Oh, it's
50 billion. So
yeah.
I don't know. Let's see, Berkshire Hathaway, here I am talking about not being in mega caps. They're pretty mega cap. Yeah. Bill.com. Do you like Bill.com? You use Bill.com?
You know what? I've used Bill.com. It's been a little bit since I have, but they've been around for a long time. And I feel like they've gone through a number of different iterations. I feel like, I think, and I'd be interested to see what they look like.
All right, let's take a look.
Let's take a look at
25 billion.
Yep. By the way, if anybody out there watching here, thank you guys for tuning in. By the way, if you have an idea for an asset that you want to see us drop in here, put it in the live chat. Let us know, and we'll stick it in here if we can find it. We have most of the domestic U.S. stocks that you trade here, as well as a handful of cryptos, about 100. So if you've got a symbol you want us to try, let us know. We'll drop it in. So Bill.com, okay, looks 6.49, pretty volatile.
Yep.
0.48. 30% growth over the past year, so still up quite a bit from a year ago, even though it's been a rocky ride to get there.
Yep. Yeah.
Yeah. It might, this is one of those things where for me, I don't want a lot of super volatile positions in my personal portfolio because I feel like I'll look at it every day and I'll start to go a little crazy.
Schwab.
Yep.
I'm a fan of Schwab.
Yep.
Out of all the brokerages, although they did buy TD Ameritrade, and TD Ameritrade is like as bad as Robinhood when it comes to payment for order flow.
Yeah.
So that's bugging me. But of all the retail broker dealers, I think Schwab is one of the best.
Yep.
And we don't have a lot of financial in this portfolio right now, so let's just check it out. SCHW.
And then I've got another idea for you that I want you to put in.
Okay.
After this,
if we look at Schwab.
Yeah, Schwab is.
So they've they've been having. This is the 0 to minus 0.5% day, right? So they've had them. Their biggest day has been between a loss of 0.5% over the past year, right? So let's just see how it fits in the portfolio. Ooh.
Look at that.
Raise the risk efficiency quite a bit.
Yep.
Raise the D score a little bit, but still, well below the S&P 500 itself. So
yep.
And I'm not disliking it.
Yeah, absolutely. I think this is a good ad. And that's another interesting thing that I think is worth pointing out here is that, sometimes you add something, risk efficiency goes up, it gets more risk efficiency, but D-score also sometimes goes up. And obviously the ideal is to push risk efficiency up with D-score down if you want non-volatile, very rewarding portfolios. But to some degree, getting reward comes with accepting some risk and volatility, right? So we get a bump in this, but we also have to be able to stand a little bit more volatility, but not a ton here.
Yep. All right. You said you had one you wanted to take a look at?
It's right there. Alcoa, AA.
Alcoa. Wow.
I love this. I bought that. This was one that if you look, it just has insane numbers. It's been doing so well over the past year.
Wow.
I grew up right outside of Alcoa, Tennessee. So I used to drive by Alcoa, the Alcoa plant that was there all the time. And so I put this one in my portfolio. I like to see what it does. It's been a good one for me for a little bit here.
Yeah, and I would not have thought of it, but I like it. It goes into the kind of commodities play.
Yep.
Hey, score.
Love it.
2.05. We got up above 2.
Now we're up above. Now we're really coasting, right? Like above 1 is where you really probably want to be.
And it's a pretty volatile stock.
It is, but most of its volatility is on the upside, which is really interesting.
Yeah, I mean, look, that can be a double-edged sword when trends change, but but hey, so let's pop over here. What do we got? 9 assets in here now. Let's take a look at our covariance matrix. Look at how uncorrelated Atlassian is.
That's great.
Isn't that
interesting? That's amazing, actually.
That's amazing. That is amazing. And let's see, what else? Alcoa. It's not, not terribly correlated, but man, Atlassian is.
That's wild.
That's wild. Huh. So I know being a technologist, another one that kind of caught my, I love these data technologies like Datadog, MongoDB.
I'm a big MongoDB fan. We use it at RiskSmith.
Yep.
I've used it for years and years.
Well, you're not the only fan. There's a number of asset managers that like it too. It made it into the Whale Wisdom 100.
Excellent.
So, shall we try it?
Yeah, let's look at Mongo. I know it suffered
MDB.
A little bit. Suffered a little bit last fall. I remember seeing around October, November when everything got a little bit more volatile.
Yeah. Yeah, I mean, definitely a volatile stock, 6% D score, right?
Yep.
Risk efficiency kind of below 0 right now, just on the edge.
Yeah.
Lots of big down days of 5% or more.
Yeah.
So that'd be interesting just to pop it in here and see.
Yeah, let's see what happens. I think it's going to pull everything down, but let's see.
Yeah, no doubt. Okay. Not as much as I thought.
Down as much as I thought. I really would have thought it had a bigger impact. Yeah.
Yeah. Huh. I don't dislike it.
Yeah.
I mean, it's down. I mean, look, there's been a serious correction from October of 2021, late October 2021, right? You're gonna have to put up with some lower prices. But that can be a good thing if you're just building a portfolio, especially if it's a company like MongoDB that, it's not hurting your risk efficiency that much. Yep. I think it's holding up pretty good, actually. And, you're getting something with, I think, some serious upside potential.
I feel like, you look at it long term, you think about long term horizons here if you're a longer term investor, and you look at it and you go, you know what, like right now it might be going through a bit of a rough patch, but putting it in the portfolio didn't hurt it that much. You believe in it long term. You can look at it and go, that's a bet that maybe I'm willing to take here.
Yep.
All
right. What else?
Let's see. Who else? What do we have in here that's pretty uncorrelated? What's that Liberty Broadband Corp? What do they do?
They're a cable company.
Okay.
I think that's John Malone.
Okay.
Mercado Libre could be interesting. Get a little international coverage.
Okay. Take a look and see. And by the way, like for all of those who are watching out there, like this is a lot of the process that we use when we put together portfolios. There's a lot of sort of just like getting suitability, right? It's about like putting things in, putting the pieces together, companies you like, companies you're interested, trends you want to support, things you want to see happen, and working the portfolio, working the combination like a game, right? And this is a great thing about the app is that you can sort of do this for free and for quick, like very easily, right? And it's kind of fun to do. And like this, you're building a portfolio like a professional portfolio manager in a lot of ways would, right? And it's a fun way to go about it. Okay, Mercado Libre.
I think it's a little too
seems a little risky.
A little too red for my tastes now.
Yep. This is one that I think.
All right, we're up to 10. I think we got a good thing going here.
Yep.
Maybe look in some other sectors. Shopify. I think Shopify is doing a great job.
Yep. Oh, we had a question in here, and also a symbol to try. So let me see if this symbol's in there, Richard. It's SBGSF. SBGSF. See if we've got that one. We may not have that one. I don't know what exchange that is. We may not have that one quite yet. We support quite a few exchanges, but sometimes there's pink sheets, OTCs, and stuff like that we're still working on. Somebody did ask us to explain the difference between the simulated portfolio and the managed portfolio and the difference between the two values. And I'll go and explain that while you're looking for the next one we're going to try here.
Okay.
the difference between those two things in the app is the simulation lets you kind of play around just like we are, and it will automatically bounce the portfolio for you in terms of allocation. So you can select volatility weighting, which we have today, like we're looking at right now. You can also switch that to equal weighting, and it lets you see how these things generally will combine together. When you flip that switch over to the manage side, that's there to enable you to really now track your actual portfolio that you are managing. And so now instead of it automatically doing the allocations for you, you get to put in the amount of shares that you actually hold of that particular asset, so you can really dial that in a really fine-grained way. And I'll tell you, there have been times, Richard, when I was talking about this just the other day with somebody, that the volatility weighting is a great sort of cheat code, if you will, to kind of get to allocations, right? Mm-hmm. But even my portfolio right now is performing better by the stats with my custom allocation that I just sort of ad hoc stumbled into than it does in any of the simulations, right? And again, it's another great example of there's really not right answers here, and it's about like trying to drop them in, play around, and see what happens. How about DBRG? Or you can try Spotify too. DBRG.
I tried Spotify. I mean, look, these stocks are way down. I don't think it's a bad time to be nibbling on a new position in some of these really beaten down names that you might have a genuine interest in. Yep. But
Digital Bridge
looks interesting.
So real estate trust, investment trust. So a REIT.
Not bad.
Okay,
like
3 point. Yep.
Let's try it.
See what happens.
All right, bro. I mean, not too much damage.
No, not too much.
I think that's still holding good. Let's see what it is without that one more time.
195 and 193. One thing I want to add in here is where you can see the before and after, so you can really track that.
One last thing, Justin.
Yep.
And we can talk about this, but this is the Investor Hub. It's got some asset managers in here and their picks. And I've picked a few asset managers that I was interested in following. We're actually going to be getting rid of this piece and just replacing it with what we call smart lists. But still, it shows how you can use our app to find investment ideas that are minimally correlated to your own existing portfolio. So let's just get rid of these guys. Pick a few new ones. HT Partners, I like their risk efficiency, 0.94. And these are conservative, longer-term focused investors. I tend to be attracted to more aggressive stuff myself, so it's good to find some ideas that from fund managers who are a little more conservative than me by nature. So let's just take these two. Okay, we'll jump back over to our current portfolio and search by assets my investors hold and show these by least correlated.
This is something that we call the Relatron.
The Relatron. And
this is a really powerful thing, right? This is showing you all of the positions that these investors you follow hold, and then sorting them by least correlated to your portfolio, which is, by the way, something that if you try to do in Excel, it would take you probably days.
So here's Procter & Gamble, right? Consumer discretionary.
Yeah, there we go.
Let's check it out.
Let's definitely check it out.
Boom.
Ooh. Now let's look at the covariance matrix. Let's look at the covariance matrix and see, you can see this. Look at the PG. Look at how dark that line is, right? Yeah. And that line's dark because it's the least correlated. We found the least correlated for you, and that's why that's one of the reasons why it's doing so well. Now,
look at that.
Correlation in everything.
That is sweet. Let's go back over here and look at P&G, right? Doing very well. Low D score, great risk efficiency.
Yep.
And found for us by the Relatron.
Absolutely. Yeah.
Love it. Let's see if we can find one more. That'll get us up to 12. Yeah. A lot of these, not surprisingly, are bond funds from these conservative investors.
Yeah.
but they've got Johnson & Johnson, Eli Lilly. You know, we don't really have healthcare in here. AbbVie, I think they're interesting. Pepsi, Verizon.
Yep.
I ought to invest in Verizon, given how much money I've paid them over the years.
I was going to say, I've been a customer of theirs for so long. I probably should be benefiting. Intel,
right? You know, one that I've been actually doing pretty well with is Applied Materials.
Oh, AMAT. Yeah. Oh, you know what? You're going to have to switch over to all the assets because your investors don't hold it.
Let's see how Applied Materials might work in here.
Yeah.
Oops.
Okay. So
brought it down a little bit. Let's take it out and add it back in. Just see what the numbers were. 2.28. Yeah. 1.29. All right. No. I'm going to jump back to the Relatron. Try to find us one more that could really put us over the top.
Goose this one here.
So
how about J&J?
J&J. You know, I think I'm like an AbbVie a little more. They're a little more biotechnology focused.
And if you look at history,
or Pepsi, Pepsi looks pretty good. Except I just can't endorse soda. But they do more than just soda these days.
That is true. Yep.
Ooh.
Oh yes.
Yes.
Oh yes.
Think,
with a 1.19
got a keeper there,
which is super low.
That's crazy.
That's crazy. Now let's
look. Good portfolio.
I'm just curious. Click over to the growth, because I want to see, like, wow, look at how uncorrelated this thing is. All that dark in the covariance matrix. That is a beautiful thing to see. I want to get a tattoo of that. If you look at the growth, these stats will show you like how this has trended over time. You know, so you can see here's the risk efficiency of this over time. You know, this portfolio over the past year has grown 29.37%, almost 30%, while not being very volatile. While trading risk for reward quite well. You know, so this is an experience. If you had invested this in a year ago, you could have expected that you would have had a relatively steady climb up 30% over the past.
And look at how, you know, going back to what does that uncorrelated do? You know, look at how low the dips are here.
That's right.
So that's why you're getting,
like the NASDAQ,
you know, a high risk efficiency. You're steadily climbing and you're not having big dips. Yep. Boom. Yep. Magic.
Let's benchmark that on the NASDAQ real quick to see that in motion, right? Because this is going to show you, you know, and especially toward the end there, you can really see this is where the correlation helps so much, right? Or the lack of correlation, because when the NASDAQ falls off a cliff, as it did the past few months, we're able to ride that out and get alpha out of it, as it were. Yep.
All right. Well, I think we've put together a fine specimen of a portfolio here. So for the record, that's Alcoa, AbbVie, Berkshire Hathaway, Bitcoin, some grains, Ford Motor Company, Floor & Decor Holdings, gold, Mongodb, Procter & Gamble, Schwab, and Atlassian. I like it. You know, it's got some new tech in there, but it's got it's got some commodities, and it's got some good standbys with Berkshire Hathaway and Procter & Gamble and Charles Schwab and AbbVie. I think we've delivered.
I'd put money in this portfolio. Absolutely.
All right. Anything else you think we should highlight for folks?
I think that's great for today. But certainly want to say to everybody who's listening, if this looked interesting, if you're curious about this, RiskSmith is totally free to try. Totally free to try. You can go and to use right now, risksmith.com. You can sign up right there, start putting this together yourself. And what I hope people find is that this is actually a lot of fun. And it works.
And by the way, you can do volatility weighted or equal weighted. Let's just see, you know, the equal weighted lowered the risk efficiency and raised the D score.
Yep.
Absolutely. Volatility weighted. Wow. Look at that.
Yeah.
It's a huge difference.
A huge difference.
All right, Justin.
Great. Excellent work, sir. I think we put together a good one. We'll have to do this one again soon, I think.
Yeah, I think we'll be doing this regularly. So hopefully this is just whetting the appetite. But I hope everybody enjoyed it, and it was a lot of fun putting together. And Justin, man, you have done a beautiful job putting this thing together. It's gorgeous and fun to play with, and
it is a team effort. I will tell you that. that is for sure. Somebody did ask us, and maybe one last answer before we drop off here. Somebody asked, how often do you check in on your portfolio? And you can answer for yourself, and I'll answer for me, because I think it's a personal thing to some degree.
Yeah, I mean, I check in generally once a day, but I make changes about once a quarter.
Yep. Yeah,
and if something's really going off the rails, then I might make some adjustments mid-quarter.
I've developed a habit of getting up in the morning, checking my RiskSmith scores for yesterday, because we update the data every morning for all the data that came in yesterday. So we do it on a daily basis. So I look at it every morning and check to make sure my numbers are still looking like they're trending in the right direction. And then during the day, I'll look at my brokerage account just because I'm curious as what's happening. But I'd say that RiskSmith drives my decision-making way more than my brokerage account.
Awesome. All right. Thanks, Justin. Thanks, everybody. Have a great afternoon.
We'll talk soon.